Abhiraj, FY25 saw a turnaround from heavy losses in FY23 and 24 to a profit of 239 crore rupees. How sustainable is this profitability trend?
Aabha, so if I talk about the last three financial years, we have gone from about 437.5 crores in revenue from operations in FY22 to about 1144.5 in FY25. And of that 707 crores of incremental revenue that we have added to the top line, we've seen a translation of about 385 crores moving to the adjusted EBITDA, going from negative 373 to positive 12, and about 540 odd crores in the profit before tax, going from negative 514 to positive 28. Now, the profit after tax has a deferred tax asset of 211 crores. I would urge your listeners to ignore that accounting entry because that is taken in lieu of future profitability. The real profits that the company generated should be seen as a profit before tax level, which is about 28 odd crores, or the adjusted EBITDA, which is about 12. So you can say more or less the company today is at a break-even stage. On a base of about 1144 crores of revenue, we've generated small profits, but it's turned a corner. In our kind of businesses, investments happen upfront in technology, training, brand building, and customer acquisition, etc. And once you hit a certain threshold scale, the fixed costs don't grow linearly with top line, and one can expect a meaningful percentage of the top line and contribution margin flowing into the adjusted EBITDA.
Okay, fantastic. So with PBITT margins improving, what's the roadmap for achieving stable double-digit margins? In the news and analysts, Abhiraj will always be asking for the next step. So now that you've gotten to this level and, with that clear positive coming in, even though it's still in narrow levels, how do you see that improving?
So, Aabha, we see our business in a few parts, and I'll just take a couple of minutes to talk about this. We have our core services business in India, where we offer beauty, deep cleaning, electricals, plumbing, carpentry, AC service, etc. That business is already fairly profitable today. It did about 3% of net transaction value, which was 3,271 crores in FY25. So it did 3% adjusted EBITDA or 10% of net revenue. Our goal is to continue to grow that business and continue to improve margins therein. In the first quarter, we reported a 4% margin as a percentage of net transaction value. Then we have three other businesses which are still loss-making. This is International, Native, and Instahealth. These businesses will take some time to fructify. We are committed to growing them over time with profitability. And in the first earnings call itself, we will come out to shareholders with clear guidance of what is the time horizon by which these businesses can turn a corner, what kind of investments will be needed. Overall, in the long run, we are definitely committed to building this business with not just one eye on growth, but very importantly, the other eye on profitability. And when I say profitability in the long run, I do mean PAT and cash flows, not just adjusted EBITDA or EBITDA, which are, in my view, interim metrics to eventual PAT and cash flows. So that is a commitment. But at the same time, I would urge our shareholders who are showing a lot of faith in the company to be patient, to give us some time. We are a young company, we are ambitious, we are growing fast, and we do want to continue to invest in some of the new areas such as Native and Instahealth to set them up for a fruitful future trajectory.
If you like the video, do like, comment, share and subscribe.